Welcome everyone to this interview with Andrew Bailey, Governor of the Bank of England. It's a pleasure to have you here with us live today, Andrew.
Well, thanks, Caroline. It's a real pleasure to be here. Wish I was obviously with you in person, but next best thing, is it? I guess.
Indeed, lost, as they say. Eh? And just before we start, Andrew, if I could just cover a little bit of housekeeping for our audience. Just so that if you're not aware already, on the right-hand side of your screen, there's an About Session Information and Participate in the toolbar. And throughout the session, please feel free to submit any questions in the Q&A box, which is part of that Participate tab. And we'll try answering them as we go through or at the end. The session's being recorded and it will be made available for replay at the end of the day. So you can look at it again over the next 30 days at your leisure. And then finally, do engage on social media, join the ACT's LinkedIn groups, follow us on Twitter at ACT Update, and tweet using hashtag #ACTAC21. But without further ado, I'd like to jump into this interview. Now, Andrew's bio is here on the platform for you to read, so I don't intend to go through it all. And in fact, he needs a little introduction to our audience, especially those of you in the UK. But maybe for the 49 other countries, you might like to study it a little bit. And I'd just like to flag up his amazing pedigree, if you like, having held the senior, if not the most senior roles in the Financial Services Authority, the Prudential Regulation Authority, and the Financial Conduct Authority. And on 20th of December 2019, Andrew was announced as the new governor of the Bank of England, and he began his term on the 16th of March 2020, to which I can only say, what timing, Andrew. But welcome again. And I wonder if I could start then with a look at what you see as the future role of the bank. The bank seems to have taken a more visible role in dealing with matters beyond the setting of monetary policy recently, with discussion on areas such as climate change and digital currencies. Is this a specific policy, and what other areas will you be commenting on during your tenure?
It's not a policy to extend the bank's reach, as it were. I would put it slightly differently, well, very differently actually, and say, I think we have essentially two core purposes: monetary stability and financial stability. And that's obviously true of central banks as a generality. Now, in pursuing those two core purposes, we obviously have to pursue them in the context of the times we find ourselves in. So we can't in a sense, isolate ourselves and assume that we're an island pursuing a rather purist notion of financial stability and monetary stability. So we have to respond to the things that affect us. Not everything, obviously, because lots of things don't affect us. So I think if you take climate change, which is, I think, the best example of this, our view is actually climate change is going to have a substantial effect, on our economy. So by the way, I say that, whether we tackle it successfully or whether we don't, either way, let's hope we do, by the way, but either way, it has an effect. And it affects both financial stability through the balance sheets of financial institutions, through investment in the economy, and it affects monetary stability, again, through its effect on the macroeconomy, through investment channels and so on. So my counter to those who say the bank's overreaching on climate change is to say, well, it's a pretty extreme and frankly strange assumption to think that it has no effect on our core purposes. Digital currency is slightly different because, well, it's very different actually, because I think digital currency absolutely goes to the heart of what a central bank is about. I often say that, in my experience, it all comes together, as it were, in the what is money, what is currency, and by all comes together, I mean both the financial stability and the monetary policy objectives come together in that. I mean, the heart of central banking is money and currency, in terms of how we do it, what the impact of our definition of money is, both on monetary policy, on inflation, and on financial stability, on the configuration of the bank, of the financial system, and how it operates. So, to me, there is just no question that the digital currency question is absolutely at the heart of what a central bank is here for.
And fascinating times. I mean, in general, how do you see the role of the Bank of England evolving over the next 5 years?
Well, it's interesting to look at over the next 5 years. First of all, by the way, of course, if we'd gone back 5 years and tried to predict the 5 years we've had, we'd have, I suspect, been somewhat wide of the mark, to put it mildly. And that's important because we've had a decade or more now since the financial crisis, where we've had, very substantial events, as I might say, starting with the financial crisis, the COVID crisis more recently, a few things in between as well. The shocks hitting the economy and therefore hitting our objectives have been much bigger. We had before that, we had a decade which was in many ways very, very stable. We've now had a decade or more, actually, which you can't really say that in terms of the shocks. Now, one of the things I take from that, and this is the planning that I think any central bank like us has to do going forwards, is, well, how are we going to, make sure that we are in a position to, to respond to whatever may come our way, as it were, over the period ahead. Now, we know some things. Obviously, I think we do have to take the economics of climate change seriously. We do have to take the economics of digitalisation, including digital currency, seriously. But we also have to look at how the central bank puts itself in a position to respond, because just to give you the most stark example, we're coming out of the COVID crisis. Economically, seriously, but we are coming out of the COVID crisis, and that's good news. But the Bank of England is coming out of the COVID crisis with a balance sheet of around about £1 trillion. Now that is, I can tell you, substantially bigger than the Bank of England's balance sheet, in the past. It's necessary, it's been done, for very, very good reason. But we have to think hard about how we manage that, the role of the central bank, and therefore, our operations, our balance sheet, our use of policy tools going forward. So that's going to be a major issue for us, over the 5 years ahead.
Yeah, absolutely. We'll probably come back to that actually. If I just shift emphasis slightly, but it's all connected, I believe. Diversity and inclusion, they're clearly a focus for the bank at the moment, and I've certainly been invited in by your team a couple of times to talk on the topic. Can you tell us a little bit more about that focus, and also why this topic also is so important to the economy?
Well, I think obviously, again, the Bank of England doesn't live in an island. I mean, it's affected by everything that's going on around us. Some of the very difficult and disturbing events of the last year. If I say, as you said, I don't exactly demonstrate perfect timing in my my take up of the job. And so, obviously the COVID, everything to do with COVID has been the dominating thing. But if I look back at things that have happened in the last sort of 15 months or so, I mean, obviously the whole question of the events, tragic events around the death of George Floyd and so on, and the response to it, have been another issue for us as an institution, because we are an institution. We're an institution of people. We've got over 4,000 people. And one of my jobs is to ensure the institution functions, that its the staff are treated appropriately, feel that it's a place they want to work in. And so it has caused us to look again. It's not for the first time, I should say, but it's caused us to look very hard at the progress that we've made in terms of the diversity and inclusion objectives and agenda over more than a decade now. And I think like all institutions, finally, we look at ourselves and we can see definite progress. I mean, don't get me wrong, we can see definite progress. We can see things that we've achieved, and we can see things, frankly, that we need to redouble our efforts at. And I think it's important for an institution like the Bank of England, because we are here to represent and to fulfil the public policy of the country as a whole. We've got to, in a sense, represent the country as a whole, and we've got to broadly bear a resemblance to the country that we represent. We can't be an institution that is out of kilter, as it were, with the country that we are here to serve, frankly, and that's an important thing. So yes, there are very important issues, and I say we do need to redouble our efforts. No question about that.
And presumably the bank is in a great position to be able to at least influence the financial services sector, because of the broader sector, which is known to kind of, well, to be needing to catch up a little bit on some of its diversity statistics and inclusion?
Yes, we can, but and we do, and we have very active conversations with them. But I would say in this area, I mean, you've got people who live in glass houses shouldn't throw stones around. I mean, I've got to be very clear that there's as much an agenda for us as the Bank of England as an institution and as an employer as there is for other financial services organisations. I'm not going to pretend that we can sit on a sort of on a pedestal and sort of pronounce on this one. I often say to other CEOs, I'm as eager to learn what you're doing as to explain to you, what we're doing and what we're doing, because frankly, I don't pretend that we have a monopoly of wisdom. We're an organisation that needs to learn. It does.
It's great to hear you taking that approach. Though I have to say, I know that you have done some great things in the Bank of England, and there's always more to do. But great strides have been taken. Now, just moving back and on to some of the themes of G7, the UK regulatory environment post-Brexit, if we may. What's most on your mind, and what would you like to highlight to the Treasury community?
Well, in the G7, I mean, let's start with the G7 and then sort of broaden it out. I mean, we've obviously culminating in this weekend, but we've been through a sort of a major G7 sort of round, if you like, in the last month, really, and we had the finance ministers and governors round culminating just over a week ago. And I think if I sort of highlight the main headlines there, by the way, I mean, first of all, to say there is a lot going on in the G7 on this front. I mean, I think it is interesting because there was a point 10, 15 years ago where I think people were genuinely saying that the G7 got a future. I wouldn't say anybody says that now, actually. I think it's obviously not the only group. It's not even the biggest group. It's actually one of the smaller groups numerically. But I think it does have a role. It does have a coherence and a role. So in terms of the finance and track, as it's called in the G7, I think obviously how we come out of and recover from the COVID shock, how we use policy tools, fiscal and monetary policy tools, is something we discuss actively. I think we're all in the business of sort of how do we bridge through the shock, and then how do we manage through to a sort of sustainable future, bearing in mind that we're going to come out with high levels of debt, both in the corporate sector, certainly in governments, not so much in households actually, but certainly in corporate sector and certainly in government. So that's the first thing. Climate change, second thing. I think major shift in the energy in the G7 on that one. We've got the COP26 conference, which again the UK is hosting later this year. And no secret, I think the change of administration in the US has been a major shift in that respect. And so I think we're now going through the point of let's really nail down what we can achieve, particularly this year, and then sustain that going forward. So areas like disclosure, very clear relevance to the ACT, I'm sure. Disclosure standards, the use of economic scenario analysis, something we're actively involved in, to try and map, if you like, the effect of climate change on economies, and how we incentivize investment and how we incentivize financing of investment. Again, another major question. So that's a set of issues. Digital currency, another important set of issues for G7, because all the G7 countries are looking at this actively. A lot of common ground. We published a major discussion paper last week on sort of the financial implications of digital currency, but we're still very much in the sort of asking big questions and trying to work out sort of sensible ways to answer them stage. So that's another thing. Obviously, I should have said in the context of COVID, the whole question of vaccine supply is important. That crosses the finance track and the broader tracks, obviously, health track, because there's no question, of course, COVID is a global shock, as is climate change, of course, as well. I mean, they're two classic, they don't know borders in that sense in terms of the shocks. Turning to the regulation issue that you highlighted, I mean, there's a number of things here. In the sort of the global community, major issues around what we learnt last year in the sort of so-called dash for cash episode in sort of my first couple of weeks as governor. Major pressure on financial markets, major policy response from central banks particularly, which had an effect, had a very positive effect, but there was a lot of focus, particularly on sort of the non-bank financial sector, as to what fragilities we see there, their potential for disruption of the financial system, and what we can do about it. So that's, if you think about the agenda of the Financial Stability Board, that's right. I suppose I'll finish with one that's always dear to my heart, which is LIBOR. Also very important, the ACT as well. So since I've been on the LIBOR trail for, it seems like ever, it's more than 5 years now. We are now, pursuing the end of LIBOR into its late stages now, but it's critically important, obviously, to stay focused on it, respond to the needs of your members and other parts of the economy in terms of the tools available to substitute for LIBOR, how we deal with the legacy, because that LIBOR does leave a very big, long legacy, some of which is tougher than other parts. We've made a lot of progress. I think there's a very clear commitment. I think if you want to see that commitment, and I've got 40 minutes to watch a YouTube session, the Federal Oversight Committee, the FSOC, the Financial Stability Oversight Committee in the US, covered the issue on Friday. They broadcast their conclusions. It's a very strong message on LIBOR, the end of LIBOR.
Yep. And we do have sessions later on in the week, of course, with the NACT joining this conference. We've got some joint sessions, and we'll be talking ahead at a certain point. So it's such a huge topic, and as you say, 5 years on, it's still hugely important. Another topic that might interest our audience is, of course, money market funds. And I'd just like to ask you why continue to be concerned about MMFs, in particular emphasising the cash versus investment role of the product.
Yeah, well, you're right, Caroline. So when I talked about the non-bank financial world, money market funds is part, but not by any means all of it. But we did see quite substantial stress last spring in some areas of the money market fund world. And of course, it has to be said, this is the second time we've been there, in the sense that we went there, we ended up there during the financial crisis. And it was, there are many, by the way, there are many good news parts to the COVID crisis in terms of financial stability. Tell that story for a moment. The banking system has stood up, and as I always say, we want the banks to support the economy, not the economy support the banks, please. And I think the last year or so has provided much more evidence of that, and that's very good. Money market funds have been an issue, were an issue again last spring. And I think what it points to is that for some parts of the money market fund world, there is a sort of inherent ambiguity. So some parts of the money market fund world, I think, are clearly understood to be cash instruments, particularly the government funds, in the way many of them are structured, where the assets are clearly liquid. I think investors can have confidence that they've got a cash instrument. Okay, there's some issues at very, very low interest rates in terms of the returns they pay, and the sort of the buck issue, do you break the buck or not issue, but basically these are liquid funds. You could say there's the other end of the spectrum where they are investment funds by any other name, and they should be clearly not, in a sense, badged as liquid. They should be badged as, they will behave according to the sort of, in a sense, the sort of circumstances they find themselves in, and investors should expect that, for which, of course, they would get a great return. I think the problem with money market funds is that there's a sort of there's a population in the middle that is, the risk is that it's badged as a liquid, it's liquid, but actually isn't in times of stress. And the risk that we are very focused on is that can then, in a sense, be a sort of self-reinforcing risk to financial stability, in the sense that the expectations of investors then shift quite suddenly. They want to get out of the door before their fellow investors. You get the rush for the exit, and then the big question is how that knocks through into broader broader risks of financial stability. So those are the issues. Now, this is still very much under active, it's a big work topic for the Financial Stability Board. Again, covered in the broadcast the FSOC in the US did. We've covered it in the FPC and in the Bank of England. We'll go on the FPC. We're about to be in another FPC round. It will be a major feature of that round. So it is an area where we feel that we do need to arrive at, frankly, a much clearer understanding of sort of what's under the lid, as it were, in terms of the funds. But there's an, by the way, this is not to say there isn't a role for both sorts of funds, the liquid and the investment fund type world, but it's got to be clear what they are and that the rules of engagement around them, how they behave, the sort of ways in which they can respond to a stress, and and limit or structure investor payouts and so on, are consistent and well understood.
Well, thanks very much. And Andrew, you referenced the stability of the banking system. And I often think, and have often thought over the last 15 months, if we'd had a pandemic in 2008, where would we be? So
yes,
we may have found a regulation, it is onerous, it's time consuming, etc., etc. The fact that we had a stable banking system when the pandemic hit and it remains stable is a huge thing that I think we have to be very grateful for, all of us. So just then, we touched on LIBOR, and of course it's been a huge thing, as you acknowledged, for the ACT. One of our policy and technical team, I think she's been pretty much full time on it over the last year or two. And I suppose you touched on it. I'd like to ask you, what kind of role do you think you'd like to see corporates play in the second half of the year to ensure success? And what do you consider to be the remaining challenges over that period?
On LIBOR.
LIBOR, yes, please.
Well, probably the best way to describe our approach has been in the most recent period is that we wanted to, in a sense, end the new use of LIBOR so that we could then focus attention on the legacy. And of course, stop the legacy growing. At the, there's two payoffs there, as it were. Stop the legacy growing and then focus on it. So now, to end the new use of LIBOR, we had to sort of credibly create the set of tools and instruments that markets and people said they need to do that. And that's worth saying. It's not straightforward because LIBOR, I would say, has grown in a largely unplanned fashion. Nobody sat down at any point in time with a blueprint for LIBOR. It's grown because it's there. I always say to people, the best way to think about it is it was always there as what seemed to be, if you were writing a contract and you needed a benchmark interest rate, well, put LIBOR in, it's always there. Put a LIBOR tenor in. And what you've then got is, because you've got two parts to it, you've got a derivatives world and you've got a cash market world. Now, the derivatives world is bigger, but it's more homogeneous. So it's been, relatively speaking, a bit more straightforward to deal with the derivatives world. We've had huge help from ISDA. Hugely grateful for all the work that Scott and his colleagues have done in ISDA to help us address these things. But we've made very, very substantial progress. The cash world is hard in the sense that it's numerically smaller, but of course it's quite diffuse. It's not a single thing. It's loans, it's bonds, different. You go to different countries. Classic case, LIBOR is used in mortgages much more in some countries, not in others. It's, as I say, it's a sort of, it's always seemed to be the convenient last resort. If you're writing a contract and you need a rate, put LIBOR in. So we don't know always what it's being used for around the world. So we've had to come up with a sort of, the best, with extensive consultation with all parts of the market to say, what do you need? And what do you need going forwards? And many of the most recent issues there, to what extent you need term rates and to what extent you need forward-looking term rates as opposed to backward-looking term rates. Certainly for sterling, we're there, I think, pretty much. And I think with the dollar, which obviously is the biggest market, I think there's a very, very strong commitment now to get there with SOFR. Then, as I said, you get the legacy. Now, the legacy is, as I say, is some of it's more straightforward and some of it's quite tough. A lot of progress has been made. Again, a huge amount of cooperation and consultation with the market, with all the bodies in the market, including ACT. How we develop the tools and what fallbacks we need. We're making progress on across a number of jurisdictions on legislation as a fallback. We said for a long time, please don't rely on legislation, but legislation is coming through actually, and that's helpful. We're getting progress where it can be done on people renegotiating contracts, and that's excellent. But we know some contracts just don't lend themselves to that. So I think the whole purpose now is to come up with a toolkit and to put it to work to say, we're not going to leave you, up the creek without the proverbial paddle, as it were, i.e. the paddle being LIBOR. We'll give you, there will be something else, there will be a means of dealing with this legacy, because the fact of the matter is, of course, that LIBOR has a long legacy. It's, there are contracts struck out there for decades, which have to be dealt with.
Absolutely. And it's incredible when you talk to people around the world, and some still haven't looked at all their contracts, even late payment clauses. They haven't even thought. They think, oh, it's something over there in the UK.
Don't take care of it.
It's not. It's everywhere. Thank you, Andrew. Before we're going to any of my final questions, I see there's quite a lot of audience questions coming in. So I'm going to, if I may, pick the most popular ones to pose to you. Digital assets, I think we've talked about that a little bit. But the question here is specifically, are they a threat or something to be embraced by the financial services community?
Well, digital assets, of course, is quite a broad spectrum of things. So, as we said in the paper we issued last week, I think on the area of both what we tend to call stable coins, digital coins backed by assets, real assets. I mean, we do see a potential role for them. There are some examples out there. There are ideas out there, obviously, to grow them. And the question for us is always with innovation like this, is to define the public interest and then say, what's the public interest? And for me, one of the key pieces of public interest is that I think when people are using things for payments, they expect confidence in the value of the medium they're using for payments. So, when we buy things off people, we want to set a price and then be confident that that is in fact the price for which we're going to exchange value. So the question is, what are the regulatory standards that in a sense underpin that? Because money, both commercial bank money, i.e. our bank accounts, and central bank money have that feature. They do have confidence in the value of the money that people use. Mm. Central bank digital currency obviously would be the same, because that would be a digital version of a banknote in effect. Now, when we go out into the world, sort of not there, which is the crypto world, of course they don't have the same confidence in value. I mean, they fluctuate in value substantially, which is why they're on the whole not a good medium for making payments. It does go on. But I think most people would say, I really do want to be confident that the thing I'm using to make the payment will give me a certain value. The other thing I'd say about crypto assets is that, of course, there is this sort of element to them, which is, well, what exactly are they? They're not actually a real assets in that sense. There isn't a sort of real economy asset sitting behind them. Now, it doesn't mean to say they won't have value. I mean, I've made the point they don't have intrinsic value because they don't have a real economy value. They don't have a sort of claim on a state. They don't have a claim on a real economy asset. It doesn't have to be a state, by the way. They have a claim on a real economy asset. They can have a sort of extrinsic value in the sense that, we can all want to collect things and, attach value to the things that we want to own. and that's understood. But I think it's important that people understand that's what they are. The price is volatile. I think we can see that, and none of us can provide any confidence as to what, in a sense, what's going to happen to the price or what drives the price, even actually from time to time. So they are a very different sort of assets. And I'm afraid I can't sound, I know, rather stark on this, but given the volatility of the asset value and given the fact that there isn't a real asset underpinning them, I'm afraid, if you want to buy them, then please understand that you could lose all your money. Now, I'm not saying you will. That's not the point, but you could, because there isn't a real thing underpinning them.
Interesting. Some say that the Chinese central bank will have its own digital currency in place maybe in the next couple of years even. What are your thoughts on that? And do you think the bank would be considering that in the future?
Well, I'll take them in reverse order. So we are considering it, in the sense that the paper we issued last week is quite a hefty sort of at least intellectual commitment to considering them, and it's a process we're very committed to taking forward. The Chancellor's announced that the Bank and Treasury Task Force, which my colleague John Cunliffe and Catherine Braddock from the Treasury are co-chairing. I think that's excellent. We're going to engage with users, the technology sector, to understand the potential for these things. And there's a lot of work going on in the Bank of England to understand the implications of them for central banking. So we are now. I think it's fair to say we're not as far down the road as the Chinese are, but I think the Chinese are responding. I talked to my fellow governor in China quite a bit about this. I mean, I think they've got a somewhat different set of issues that they're facing, which is they've had private sector companies that have innovated in the area of payments quite substantially. And I think they're facing the decision, which all of us in a sense have to take in our own systems. Well, where do we want to strike the balance between the role of the state and the role of the private sector? And I think that has a considerable bearing on their thinking, as far as I interpret from what I'm said. Now, I think we will come at the same question, but probably from a slightly different angle. But there's still a question about how you make the monetary system work most effectively. Our monetary system has a very substantial element of commercial bank money, and the central bank money element, which is for the public, is notes and coins, is quite small these days. Most payments are made in commercial bank money across our bank accounts, as it were. And that's a system that's grown up. We regulate the banks. We feel it's important to underpin confidence in them, but it is all anchored in central bank money, in what we tend to call fiat money, a claim of an emanation of the state. So we too will look at the question of what's the right balance between these things, between central bank money and commercial bank money, in a world where technology is changing.
We really do live in interesting times. It's absolutely fascinating. So thanks for those thoughts. I'm going to look at one of our most popular questions now, and it's moving back to MMFs. And we've got a little bit of a challenge here to ask you to elaborate on why you believe money market funds were an issue last spring. And a typical treasurer question: do you have any data that you can provide? So
I think the concern I have with money market funds, which was illustrated in the evidence all last spring, is where people hold them because they believe they're holding a liquid instrument, and they're using it for balance sheet management, cash management purposes, and the thing turns out not to be liquid. Or alternatively, as tends to happen then, to keep it liquid, the central banks have to come in with big intervention to support the sector, which is what we and other central banks had to do last spring. We made some very big interventions. Now, that was the right thing to do, don't get me wrong, that was absolutely the right thing to do in that context. But I think all central banks have to responsibly ask themselves the question, well, is there a better way of designing the system than having to do that in that situation? Because we can all imagine worlds in which we might find it more difficult to perform that piece of intervention than we did last year because of the context in which we're operating. I mean, last spring, we had the advantage that the sort of the signals that were coming from the economy were consistent with dealing with a market crisis. In other words, a big intervention was solving both problems. Now you can imagine worlds where those two things are going in opposite directions, and then the world gets a lot harder to deal with. So yeah, we don't regard it as something where we should say, well, that was job done. We can sort of assume we'll do it again if necessary. Problem over. There is a problem, and the problem, as I say, really comes from people feeling that the instrument they thought they'd got turns out not to be the one they have got in terms of its liquidity characteristics. In terms of how long would it take? It's quintessentially international. I mean, it's an interesting fact that if you look at the sterling money market fund world, I think I'm correct in saying that only one of the large sterling money market funds is actually domiciled in this country. The rest are all domiciled elsewhere, and obviously they're operating in this country and so on. So it's a quintessentially international issue in terms of dealing with it.
Thanks very much, Andrew. Loads of questions coming in. I'm not sure if we'll be able to get to them all, but there's a popular one here. What do you think of Andy Haldane's view that inflation is a bigger threat to the economy now than scarring resulting from unemployment?
Well, first of all, I mean, Andy and I are both members of the Monetary Policy Committee, and one of the great things about the Monetary Policy Committee is that 9 people can have their own views, and then we come together and we deliberated at length and come to a conclusion. I mean, Andy has rightly pointed to the fact that we are going into a period where inflation is rising. Now, the proximate reasons for this are that we are coming out of the COVID crisis. The economy is now recovering, it's bouncing back very strongly. There is a certain paradox in this, I should say. I mean, based on the figures that were released last week, the GDP figures, the economy is now probably about 5% below, smaller than where it was when we went into COVID. At the end, it's 5% smaller at the end of 2019. And that gap is closing quite rapidly. But you do have to sort of just assess the paradox on it. So the good news is we're only 5% smaller. 5% is a huge number in any historical context. I mean, to say, good news, the economy is only 5% smaller than it was 18 months ago. People would, at any point in time up until, last spring, people would looked at you and said, really? You think that's good news? So, we have to track this recovery very carefully. The second thing to say is, it's not a normal recession. In the sense that, if there is such a thing, in a more normal recession, demand in the economy falls much more rapidly and supply doesn't fall that much. And you get unemployment, and then if you get long-term unemployment, it gets more difficult to deal with. What we're seeing this time is that both demand and supply have fallen. By the way, we think demand has fallen more than supply, but the point is that demand hasn't fallen anywhere near as much relative to supply as it would do. And that's because the economy's been closed down. We've had things like the furlough scheme, which have been terrifically helpful to obviously in terms of the labour market. What it does mean, though, is that the recovery of the economy is down to what we tend to call, two big moving parts. Both supply and demand are moving at the same time. And of course, they can move at different speeds and in different sequences. And sometimes the sequence works, and sometimes it doesn't. So we are getting bottlenecks. If you take, I do a lot of virtual visits around the country, and I talk to people around, fellow central bankers around the world. People start talking about, for instance, in the US, they talk about, the lumber, as they call it in the US, the lumber supply for housing. Well, I know you can't just cut a tree down today and put it in a house tomorrow. It has to be seasoned and prepared and what have you. And these things are causing bottlenecks. We've also got a world shortage of semiconductor chips. We've got very high freight costs at the moment. There's been various things that have been causing that. And the judgment we have, two big judgments we have to make. The first one is, to what extent are these factors going to be temporary? And to what extent, even though they may be temporary, are they going to cause some knock-on in terms of inflation, wage levels? And by the way, the other big thing to say is we've had a big recovery in energy costs. The oil price was very, very low last spring. It's recovered substantially. So that's the first big question. The second big question is, what sort of economy are we going to return to when this bounce back is done? Are we going to return to the sort of economy we had before COVID, which, let's be honest, had, structurally low interest rates for reasons that are common across the world, often to do with aging population, relatively low investment levels at times, relatively low productivity growth, low inflation? Or are we going to, because we think there will be changes, there will be some changes, we're not going to go back to doing everything the way we did it before COVID. Will we see structural change in the economy? And if so, what will that effect will that have? And that's the second, the two big, I think, questions we have to answer. That's the second one.
And do you think that out of this pandemic there will be structural change? What's your feeling in the balance?
I do. Yeah, I do. I mean, how much? Hard question. But I think, take two examples, two obvious examples. If we look at retail, the retail sector, we saw about a 10 percentage point increase in online retail sales as a share of total sales last spring. By the way, that was from about 20% to 30%. It took 7 years to go from 10% to 20%. 20%, 30% happened in a couple of months, so a few months. Now, some of that will, and I think it's grown more since then. Some of that will be reversed, but not all of it, I suspect. Second big one, working patterns. Working from home, working in the office. We've all adapted remarkably well to the situation we found ourselves in without any warning. I'm sitting in the back room today. I'm not quite sure how many people are here today, but I can tell you it's a pretty, it's not a huge number relative to our total staff, and it's rising gradually. We and other organisations, we're not going to be working exactly the same going forwards. We're not planning to work. We are planning changes to the way we work. So there will be changes.
Yeah. Yes, people say that the new normal. I would say the next normal, because it's continually going to change, isn't it?
Yeah,
right. Ahead of us, but exciting times in one sense.
Yeah.
Now, we haven't got a lot of time left, but I just wondered if, and apologies to those, there's lots more questions. Our audience has been very engaged, which is not a surprise to me. I wanted to ask you all these questions, so apologies if I've not got to your question yet. But I would like to ask you, Andrew, if you've got any particular messages for the Treasury and financial services community, that's our audience today, but both of those groups. Anything that you'd like to share, any messages that we haven't got to yet in this conversation?
Well, you were very kind about my resume at the beginning. One of the things I did do for a few years was be on the ACT's advisory committee, which we used to have, and I remember coming to quite a few sessions where we talked about, and I think the Bank of England has always regarded the ACT as a very important part of our landscape. Your members do critically important things which feed into our world. And we, I should say, welcome the contact and welcome the engagement. I think we are going, as you were saying, we are going to go through a great deal of change at the moment in terms of the world we live in. And I think for us, one of the important things is to continue the active dialogue with you so that we understand how your members see the world changing, what that means for our world. So, financing, investment financing, trade finance, how all these things are evolving as the world changes around us and how they impact our world. So, my message in a way would be very much now more than ever, I would say, the active dialogue between the Bank of England and the ACT matters a lot, I think, going forwards.
Well, thank you very much, Andrew. And I'm sorry that's all we've got time for today, but just would like to remind our audience, you can pop over to the discussion zone at any point now or in the next 30 days. And some of the topics are those very topics we've talked about today. LIBOR, we didn't really touch too much on Brexit, but that's there too. ESG and sustainability, is there diversity and inclusion, and the future ways of working. So lots of the topics we touched on today are there in the discussion zone, so you can put your thoughts in or your questions, and other of your peers will be able to answer those. I'd also like to remind you to complete the speakers survey that you have there just to the side, and let us know how we're doing. That would be great. Do go to the virtual exhibition, and do remember that you can watch this session for the next 30 days when it comes up later on today as recorded. Then you will be able to watch it again to catch those insights that you maybe missed because there was a lot in there. And I'd like to then just finally again thank you, Andrew. It's been a great treat to have you here today, and thank you for being so open to answering all the questions that we had.
Thanks, Caroline, and really great success for the ACT going forwards.
Thank you very much. Take care.
Bye.